and start recording. Good evening. Thank you for joining us tonight for United Policyholders Taxing Matters webinar. Just a little bit about UP when we get started. We're a nonprofit, been operating since 1991. We serve as a trusted information resource and voice for insurance consumers in all 50 states, not for profit, not for sale. What that means basically is we're funded by grants and donations, not dollars from insurance companies. We're made up of a small professional team, largely based in San Francisco, government and nonprofit partners we work with, and then our volunteers, our fired up survivors group of previous catastrophic loss survivors who are paying their knowledge forward, and then our consumer focused professionals like the gentleman joining us tonight. We have 3 programs: our Roadmap to Recovery, that provides guidance on insurance and getting back home after a catastrophic loss; Roadmap to Preparedness, taking those lessons learned from post-disaster and better preparing people in the event of a loss; and then our Advocacy in Action, where we take those pain points that people have in the recovery process and fight for those insurance consumer rights and protections. We have, for everyone here, we've got our disaster insurance help libraries for you. This shows you how to get to it on our website. And this provides state-specific resources for you with a step-by-step guidance, links to professional help, sample letters, claim forms, and then obviously updates to upcoming events. For the Marshall Fire survivors joining us today, please take a moment to complete our 1-year survey. Here's the link. You should have received an email from us as well. The more information you give us, the better we can advocate for you. Fine print. This workshop is intended to be general guidance only. We are not providing any legal or financial advice. We don't endorse or warrant any of our sponsors or our speakers at our workshops. And be aware, our speakers today are volunteering their time as educators to help you in this process. So today's presenters, I'd like to welcome Gerald Schreiber, with Schreiber & Schreiber, certified public accountants in the Louisiana area, and then John Trapani, who is a CPA in the Thousand Oaks, California area. Thank you both for joining us today.
Good afternoon.
Yeah, good afternoon, everyone.
All right, and then Jerry's bio slide here speaks for itself, but he's been presenting seminars and preparing practice aids for CPAs for multiple hurricanes, and he's just a tremendous resource to CPAs across the country. And so, Jerry, we appreciate that you're giving us your time today.
My pleasure.
All right, and then John is he's a long-term team volunteer, and he's also a disaster survivor from the earthquake in Southern California years ago. So he's been doing this for 30 years. He's written the book on the disaster tax issue. And I appreciate so much you making it to join us today, John.
Happy to be here.
All right. A few little housekeeping things that from the UP guidance standpoint that I want to stress. We always recommend you want to stay organized, keeping your paperwork organized, having that claim recovery journal, saving your receipts, scanning, photocopying, emailing. Recommend setting up that separate bank account for your insurance funds to make this tracking process easier. Establishing a special email account for your claim if you haven't done so, just so again, everything is in one place to make it easier for you. On the bottom there's a spreadsheet that a CPA from the Woolsey Fire created for us that can help you track your insurance proceeds. This is the link on our website to check that out. Goal of today's presentation is to help you understand the tax rules and options for disaster impacted households and make good financial decisions. We'll talk about when to file, timelines, how disaster declarations impact tax matters, what the difference is between a casualty loss and an involuntary conversion gain, and why you need help. And so just to be really frank, I know outside of what these gentlemen have taught me over doing this workshop a couple of times, I know nothing about this. It really is Greek to me. So I'm going to talk about things that I'm going to read the questions to them there, but I'm going to turn this over to the experts. Here's the agenda for today. I'm not going to read through this, but these are the topics we're going to cover. Thanks to all of you who submitted questions beforehand. We've tried to weave your questions in exactly where they would be answered in the presentation. If you don't see your question on the screen, please do listen, because I will call out on the slide with your name saying this is where your question is going to be answered. And there are a few questions that were add-ons that will be discussed during the presentation today. So we're going to start first with general tax matters. So Prop 19, this is relevant to California only. Basically, this is a question for your county's tax assessor. So if this applies to you and you're not sure what to do with this is not a CPA question, it's a question for your county's tax assessor. Just flagging that for anyone in California who had a disaster after April 1, 2021. So common tax questions, these are some of the things we're going to talk about today. I'm going to read through the questions. I will have one that I'd like to get an answer from you gentlemen, and I'll ask you that in a minute. So are some or all of your insurance proceeds taxable? The answer, I believe, is it depends. The question for you to answer, will your insurance company send me a tax document? This is for Heather in New Mexico.
No.
Thank you. Which again goes back to why the paperwork is so important.
There's a qualification to that, and the insurance company will not. But I have seen people who participated, let's say, in class action lawsuits against insurance companies, receive 1099s from the law, from the law firms, or maybe the administrator of the settlement funds. So in some cases I see it, in some cases I don't. In some cases there's interest included on it. In some cases there's not interest included on it. So it's kind of all over the place. And the insurance company generally will not, but then there's these other things, and it involved a lawsuit against the Louisiana Citizens Insurance. And so I don't know what it would be in other states. So Florida could have issues because of the insurance situation there with some of the Ian and Nicole claims down the line. These generally appear several years afterwards. So nobody knows what'll happen. It's just, don't be surprised if it would appear at some time in the future.
Well, let me add for cases that I've seen. My experience is, one, my understanding is that the IRS sends not the IRS, the insurance company or the defendant sends a 1099 to the attorney for the full amount of the payment, the full amount of the settlement, although the attorney only takes his cut. But the attorney in most of these cases is actually prohibited from sending a 1099 to the client. Now, I've got clients where they are dealing with a settlement fund up in Northern California through an attorney. They're not getting 1099s, but I've got other clients where they are bypassed, did not get an attorney, or dealing directly with the fund, the trust. And because they are the ones that the trust is actually sending the check to, they are getting 1099s.
All right, thank you, gentlemen, for that. So next question, how can I have had such a devastating loss and have my insurance proceeds be considered a gain? Answer is, it's complicated. We're going to talk about that. Yes, there are tax exclusions available. If you're underinsured in one or more categories, can you offset those losses? Again, it's complicated. Litigation proceeds taxable. Jerry and John just discussed that briefly. We'll touch on it at a very high level on one slide. This is one of those areas where you need to consider professional help when you're dealing with these. Yes, there are tax considerations if you sell your lot without rebuilding. We'll touch about that later. State laws, state tax laws, again, looking at working with your CPA on that. Property taxes deal with your county tax assessor. Extensions, while file an extension. When in doubt, file, because the rules are complicated. There are many provisions to help offset the potential implications, but it takes time to know the full extent of your outcome. How about that? Disaster declarations can sometimes lag behind. They don't always happen by the IRS deadline. So just paying attention to that. And then the reality is it just takes several years to know the full extent of your possible tax implications. So Deborah has a question here. We reported our net insurance proceeds from loss of our home in the glass fire in our 2020 tax return after subtracting estimated rebuilding costs. We very much underestimated what our rebuilding costs would be and consequently paid capital gains on too much of our insurance payout. I'm concerned about filing an amended return as I really don't want to be audited. Although I have most of the receipts, I obviously don't have receipts for the cost of improvements made before the home burned because those records burned. But we had a reasonable estimation of those costs to calculate the basis. Will the IRS want to see those receipts? They didn't ask for them when we filed the return.
Okay. Well, Deborah, the cost of replacing the home, rebuilding, is really not relevant to whether or not you had a gain or a loss. What is relevant is the cost basis of the home, including the land, and that's subtracted from the proceeds, but only the proceeds for the real property, the structure. And if you've lived in the house long enough, there may be some exclusions up to $500,000 of that gain, but that is the gain. Whatever is left over, that is the gain that you have to deal with. Now, if your cost to replace the property less that exclusion, excuse me, if the proceeds less that exclusion still exceed the cost of replacements, then at that point you do have a gain, and how that gets reported gets a little complicated. But you also need to keep track of, if this was a primary personal residence in a disaster, you also need to keep track of your contents purchases for that purpose, because that can eat up some of that proceeds also. That gets a little, we'll talk about that later, but it gets a little convoluted, unfortunately, but it all works to your favor. You want to add anything, Jerry?
No, that's good.
All
Okay.
right, we're going to keep moving. Timing matters. While all of this is new, the loss of your home, dealing with insurance, it's easy to ignore the need to deal with the tax reporting of the event and resolution of the situation, but it's part of the recovery process. And there's a number of opportunities to save taxes now and in the future. Here's 2 publications that can help you with that. And just, gentlemen, just at a high level, if you can give that cautionary tale of why someone should not ignore dealing with this. I believe both of you have shared that there are penalties for not doing this in a timely manner.
Jerry, you want to take that one?
Yeah, I mean, you have to file the tax return to be able to I mean, everybody has to file the tax return, and it has counting after this, if there is insurance, if you're going to get a grant, if you're going to get an SBA loan. So there's no real way to avoid the reporting process. I don't think that the subject of having a gain and paying tax really enters into most of these circumstances. I think that's very rare. I think in most cases, the people will break even, or they will have some kind of loss if there's no insurance. But obviously, there is going to be a loss. So it's going to vary on a case-by-case basis, but you have to file an insurance claim to claim a loss on your tax return. So there's really no choice in this, and you can't, when you say the decisions on rebuilding, most people are going to have to rebuild. They just can't leave the house there condemned. I mean, there's code issues and other things that'll enter into this. Now, as far as an extension, the IRS generally, after a disaster, grants the disaster victims filing relief. When it comes time for the individual returns, the extension is automatic. So those who have casualty losses have to avail themselves of all these provisions. And if you have a casualty, you have insurance, you have to file a tax return and you have to do the accounting on what happened during the disaster.
Thank you for Jerry. That just feeds into this next slide about which tax year should you claim the loss. First, don't rush into claiming a casualty loss deduction. The losses can only be deducted in the year the loss occurs, and all claims for reimbursement are settled. There's two parts there. For losses that occur due to a federal disaster declaration, which is capital DR, in the name of the disaster, you can elect to take the loss on an original or amended return for the year preceding the loss. And then for 2022, just if your loss was in 2022, here's the information you need for that. Lynn had a question on total loss in the 2020 Caldor fire. Insurance issued 2 checks in 2021, but they were not cleared by Cal OES to rebuild until 2022. Obviously, they decided not to rebuild. And so the question is, when are those capital gains taxes due to the IRS and franchise tax? Because they weren't notified until August 22 that they could rebuild, does that change the date when the gains are due? If we buy a replacement home, by what date do they have to do it? And there's a lot to unpack in there. If it's, this is a situation with a wildfire with a total loss, people dealing with a partial loss, windstorm, flooding event, it's going to look a little different. But I'll turn it over to you gentlemen just to address the points there.
Okay, so first, we have to look at the proceeds that are coming in. As I mentioned before, we may have some exclusions. So if the proceeds exceed the cost basis of the property, then we have to determine, well, what year did that occur? The fire, I think we said, was in 2021?
2020.
2020, but maybe you didn't collect proceeds in 2020 that exceeded your cost basis. Let's say that they exceeded the cost basis in 2021. Well, then we look to see if the the exclusion of up to $500,000 of that gain applies. And let's say that that applies, but there's still a gain left over, then 2021 would be the year that the gain has been realized. And then you have 4 years, because this is a federal declared disaster, you have 4 years from the end of 2021 to complete the replacement. If the replacement is not completed, in this case by 2025, 4 years later, well, there is the possibility to get extensions, but you have to wait until the end of 2025 to ask for that extension, and the IRS only grants those a year at a time. But they're pretty liberal in terms of granting them. It's my experience. The other thing is that you want to keep track of all of your costs that you're expending, and this also sometimes people forget. This includes permits and architectural fees and engineering fees, what we kind of refer to as soft costs, because you don't see the engineering costs in the building. It's just that the building stands up for better because you had those engineering fees. So there's many dates involved here. And if you haven't started with the construction because the county's not letting you start, well, the clock is still ticking if you have realized a gain, but you've got maybe until 2020, 2023 or 2024 before it becomes a real issue. And like I said, extensions are possible. So this is an extension different from the extension of the tax return. This is an extension of that replacement period.
Got it. Thank you. Jerry, anything to add?
No, the technical term is an involuntary conversion for those who want to look into this on their own. So it's an involuntary conversion. It's code section 1033. So whoever's has this set of circumstances, you can Google those terms and it'll give you a lot of information. There's a lot written on this topic.
And unfortunately, publication 547 is mostly dedicated to casualty losses and doesn't spend a whole lot of time on the involuntary conversion side. But they have some information, and unfortunately, some of the information, even on the casualty side, is not completely accurate.
Well, thank you for that. Let's move over to the next question. For the people impacted from 2022, getting copies of your prior tax returns, start with your CPA bookkeeper. If you had an online service previously, check, they should have those records. You can submit form 4506 to get copies directly from the IRS. Just follow the instructions there. I don't think you have to write in red the official disaster title now that they're linking it to the zip codes with the IRS. And then here's information from them about reconstructing your tax records. So this link here.
And there's usually a fee when you file the 4506, but if it's a disaster situation, they waive the fee.
Thank you. Purpose of the tax rules, just really simply collect money for the operation of government. Everything you receive of value has a tax consequence, is taxable unless specified in the code. So the tax sessions we're going to talk about today serve to tell the IRS people have these situations and they should be treated differently, right? So the tax code has been amended to change the way certain aspects of disaster are treated. And that's why that event designation, being a federally declared disaster, a presidential disaster, that DR matters. If it's an EM, an emergency disaster declaration, that these rules don't apply. And again, stressing that point, these are rules that look simple until you start to apply them.
Well, I would just go back just for a second. I would just add, just to clarify, if you're in a casualty loss situation from 2018 to 2025, and it's not a federally declared disaster, the tax code has suspended the ability to claim those losses. But if it's an involuntary conversion, well, there are still rules that apply. It's just that if it's a disaster and it's either a primary residence, a rental property, or a business, there are expanded, more beneficial rules that apply in those situations. But even if it's not a federally declared disaster, if you have an involuntary conversion gain, you still get to defer that. Okay.
Thank you, John. So the question here, do you have a casualty loss or an involuntary conversion gain? And that's the question. So you're going to start with your insurance. Have the proceeds you received or expect to receive exceed the cost basis of the home you lost? If they don't exceed the cost basis, you may have a casualty loss. If they do exceed it, you have an involuntary conversion gain. What do you need to know now? Consider filing that extension for your return. This is the deadline for it for the 2022. File your return timely, report what you know. Don't rush to claim that casualty loss because it might turn out to be an involuntary conversion gain. Document, maintain your records, keep that journal of your loss, those notes, the claim number, all those details, and save receipts for your repair replacement. And Jerry, can you talk about the importance of that journal, especially for our folks who, not a wildfire loss, but wind damage, flooding?
Yeah, okay. So we talked about going back to one of the first slides. We talked about keeping the records and keeping the records on the basis in your house, and so it's the same thing with from the day of the day of the event, the day of the disaster on. There's a term that that United Policy Holders uses called a loss diary or a loss workbook, and it's something to keep track of all the information that's necessary to document the gain, to document what is expended. So from the date of the disaster on, you're going to be accumulating a lot of information, an insurance claims number. You're going to be talking to adjusters. You're going to be talking to contractors. You may be going around to price out different things that need to be done to your house, the different components, cabinets, plumbing fixtures, things like that. So it's important to keep a diary or some orderly manner. So when the time comes to compute your tax, to prepare your tax return, that you have the information available. And so a lost diary, a notebook can be whatever way you want it to be, a 3-ring binder. It can be a spiral notebook. What I recommend to some people is to write down all the information in the front of the notebook and then to tape the receipts for the expenses that they incur in the back of the notebook so that there is orderly records. You don't go to the grocery store and you don't want to buy a damaged can of peas. So the same way that you don't want to buy a damaged can of peas, whoever you get to do your tax return doesn't want a bunch of crumbled up papers that he's got to sort through to be able to come up with whatever the accounting is. So orderly reconciliation or order or something orderly with what you're doing in this during this process is important to keep track of your expenses. Now, the adjuster's report is probably going to be the first part in computing the casualty loss, and that's very because it's going to have the dimensions of the rooms that were damaged, and it'll have what the insurance company estimates needs to be done to remediate the situation. Now, just because the adjuster's report is prepared and has a dollar amount does not mean that you can't challenge that. And it doesn't necessarily mean that it's accurate because the method that they use to measure the rooms can be off in some instances. Now, that software, the software that the adjusters use is generally indexed according to zip codes. And so the prices to do the repairs is going to be indexed according to zip codes. So for instance, the cost of repair carpentry and things like that and painting probably is higher in certain places in California than it would be in Texas or Louisiana. So that's something that you have to understand. It's not going to reflect any spikes that is going to happen as a consequence of the disaster. And it's not going to reflect maybe some things that you did to the house. So if you have better fixtures, better cabinet works than just a Lowe's or a Home Depot model, then sometimes it's beneficial for the homeowner to have a contractor or some building expert there when you meet with the adjuster. And so those are just some things, but the adjuster's report is going to be the starting point. If you have the original plans, you can compare it with the room dimensions that the adjuster has on the report. So those are just things to think about when you're going through this process.
I would add just from my personal experience, which again goes back to 1994. In addition to the insurance company using that software, I hired a contractor who was familiar with that software. Without giving specific numbers, the insurance company's initial number, when we got done with the final calculations, corrected for all of the errors and missing information, our actual loss using their software, using their database, was actually 6 times the amount that they had come up with. So those reports can appear to, in that first report I looked at, oh, this seems reasonable, but it doesn't, I'm sure it's more money than this. And then we got into the weeds. Like I say, it was about 6 times more than what they had calculated.
Right. And all of this is important when you're documenting that cost basis. When you're looking at your tax records, if you're looking at where you purchased the house, getting information from your realtor, just be aware that any of these records you've got are not necessarily going to be accurate. For the Marshall fire, there are some people whose tax records missed their finished basement, and so suddenly it doesn't match up, so you don't have that documentation to prove it. And then the other thing for the cost basis, just to call out, including those home improvements, additions, enhancements. Could be landscaping, trees, other structures. It's not just remodeling the home.
I guess
Whatever
I'd
you're
add-
choosing,
yeah,
make
that-
sure it's accurate.
I'd add one more thing there on the cost basis, because of course, a lot of times where it's a fire, all of the record or a flood, all the records have been destroyed. One, Zillow is not a bad place. Zillow or the other online services have gotten pretty good in terms of coming up with purchase price. It won't include closing costs, of course. And another thing to do is gather pictures if you can. I had a client a number of years ago that their house actually was in Colorado, was subject of a flood. They had a friend who every time the friend came over to their house, she would go through the house and take pictures on her digital camera. And after the flood, and their house literally went down the river. After the flood, the friend handed the wife, my client, a flash drive that had all the pictures she had ever taken, which were unbelievably useful in terms of the client reconstructing what was in the house at the time of the flood. So that was really beneficial. So gather any pictures. I mean, maybe it's a family picture, but it shows background of the house, or it might show back in the background, it might show an improvement that you can show. Well, here's the kitchen that we remodeled, things like that.
Right. And that gets into, as Jerry said, it might be that you're taking notes, you're having conversations with people, but anything you've got that's related to that cost basis, that description of that home, your real property, putting that in one place, keeping it organized, and documenting what you have. And then stage 2 is identifying and documenting those insurance proceeds, right? You want to document and track what you receive and know what it's for. So you're tracking all your coverages, your dwelling, your contents, additional living expenses, any scheduled property, extended coverage, ordinance and law, other structures, landscaping, all of those things you want to track. Note caution, if you purchase real property with additional living expenses, you definitely have to track that expense as well, because it could lead to a taxable gain. And that documentation that Jerry mentioned, it can include your settlement letters, copies of those checks, all of that stuff, very neatly organized, will make your life much easier when you go through this.
I might add that Microsoft Excel will be your friend.
Yes. And so stage 3, documenting your recovery costs. So this is as you're repairing, replacing that home, or purchasing a replacement home. As John mentioned earlier, it includes the soft costs like your architect, your permits, testing, things like that. And then the cost to replace that lost personal property. The purchase price if you're buying a replacement, fees, inspections, required fixes. And let me read this last sentence here, last bullet. For replacing contents, you get to count these as if they were paid for the real property replacement, which has the net effect of negating some deferred gain from real property insurance proceeds. And then let's go to our tax terms. Why does it matter how my disaster was designated? It's going to impact your cash position and your tax options. So things to note here: insurance proceeds and grants or gifts specifically designated for contents damaged or destroyed that are related to a primary residence are not subject to taxation if the disaster is federally declared, even if it causes a gain or a potential gain. Contents losses can be considered when calculating deductions for casualty losses. Remember, a casualty loss is going to require a DR. You may be able to amend your prior year's return and claim a loss if you sustained a loss as the IRS defines it. If your disaster did not get a DR, then the insurance proceeds you collect for contents and personal property are reportable and may or may not be taxable. Anything you guys would like to add to what I've just read?
The DR is a reference to the FEMA website, and so you have to look. Anyone can look at the FEMA website, and under the page says declared disaster, and all the DR and the FM and the EM numbers are listed there.
Also, I think later we have a slide that talks about the IRS newsroom, and that's organized by state And that's a good place to go to see what's happening in current terms of declarations and also deferral of or delay in tax filing dates and such that it'll be identified by the active disasters.
And excellent, John went straight to that slide next.
Okay,
So as Jerry said, it's a presidential federal disaster declaration that qualifies. And then these are the additional provisions available. I'll go ahead and read them out in case there's anything to add. Contents related proceeds for damaged or destroyed property related to primary residence not subject to taxation. This is talking about safe harbor. Contents losses can be considered or added in when calculating deductions for casualty losses. And then you have additional time might be allowed for replacing items and extending coverages for certain tax filings. And we've talked about this earlier, so this is just a summary slide to bring it up. Which payments may be taxable by the IRS? If you're impacted by a disaster loss, regardless of disaster declaration, taxable reimbursements will include unemployment compensation. Payments for real estate are treated the same as if they are proceeds paid by the insurance company. Some ALE insurance proceeds can be considered taxable if used to purchase an asset rather than pay for temporary living expenses. And some insurance proceeds related to contents, also contents in a second home, and that's even if it's a federally declared disaster. Okay, non-taxable payments and proceeds. For those impacted by a disaster loss, regardless of declaration, non-taxable reimbursements may include payments for additional living expenses, and this is to the extent they are being used to pay for additional living expenses. This includes both FEMA payments and insurance proceeds. Payments from social service agencies, charitable organizations, and in-kind services such as meals, medical supplies, and shelter. And then FEMA payments under Code Section 139. Generally, FEMA payments have no tax consequence.
this can get a little dangerous sometimes. I had a client who actually was back in 2013, had flood damage, no insurance. A local church offered to reimburse up to $1,500 of cleanup expenses and repairs if they supply the bills. Well, because they were reimbursing actual expenses, that $1,500 was treated as insurance proceeds for the real property. If the church had just said, hey, we're going to give you $1,500 to help you out and you can use it however you want, then it would have come under that 139 situation, Code Section 139, and it would have been totally non-taxable.
And then, Jerry, another thing about Code Section 139 is for FEMA, it can include those additional payments made subsequent to the disaster, like funds to elevate a residence after flooding, right?
Correct. That's 139 G and H, and it was added. It was added maybe about 2003 or 2004. Because actually it was a specific set of circumstances dealing with some payments in Louisiana. Now, in 139, there's a term called qualified disaster payments. And what that is that employers may make payments to employees for reasonable and necessary payments for things like food, housing, medical, and burial expenses. And those would have no tax effect to the employee. It would be deductible by the employer. Now, that means that it's not where they can go, to go give them a new Cadillac. And so shareholder owner employees qualify to receive qualified disaster payments also. So that's something that's available to businesses if they want to help the employees after the disaster. Now, there's something going on now that that is miscommunicated, and that is GoFundMe. There's no such thing as if I pay to a GoFundMe account to be able to deduct it as a charitable contribution. To be deductible as a charitable contribution by the person paying it, it would have to meet the requirements under Code Section 170. It'd be like giving it to a church. If I give my old clothes to the person down the block who lost their house, that's not a charitable contribution. So there's a lot of miscommunications in that regard that I see sometimes after disasters. But it's important for people to know that they're if they want to, if they're listening and they never had a disaster, but they want to help somebody out, that there are specific requirements for charitable donations that have to be met, and they have to follow those.
Thank you for mentioning that, Jerry. That's something, a lot of the more recent disasters, we've seen people being supported by GoFundMe campaigns and other platforms. And it's just, the assumption is there's no tax implication on, on the consumer receiving it. And the idea is I'm donating to support, I'm donating, and that's really not the case. So thank you for updating.
Correct. So I hear it where somebody says, well, I went and got cases of Cokes and cases of bottled water, and I rode around the areas that were flooded and I gave it to people. No, that doesn't qualify as a charitable contribution. There's just miscommunication and misunderstanding as to the specific requirements. It has to be what's in the Internal Revenue Code.
Got it. Thank you. We're going to do a bit of a deeper dive here on cost basis. So we're going to start with, how is cost basis calculated for IRS purposes? 3 things to note: purchase price or inherited cost is used, not the market value, not your property tax value. Certain upgrades and additions can add to the cost basis. You added a 3rd story, you added an extra bed and bath, mother-in-law quarters, that's going to add to your cost basis. The integral nature rule for personal use real estate, that's land, fences, the home combined, can accelerate or be combined and added to your cost basis. And so,
I mean, when you go to buy a house, you buy if you're buying an existing home, it already has landscaping, it has fences, it has a driveway, it has obviously the house may have a deck or patio in the back. You just pay one price. The IRS does not require that you break out those components. It's just a single number that you paid for the house, and that's it. What you get, what you do get to add to that purchase price is certain closing costs, escrow fees, recording fees, and title insurance.
all right, thank you for that. And just to reiterate, Mark and Emily from Colorado, your questions are answered here. But it is that purchase price or inherited costs.
Now, on the other hand, I currently have a client who didn't inherit, but his parents had a cabin, mountain cabin that burned down in 2021, but they had owned it for many, many years. And they gave it to my client in 2018. His cost basis becomes their cost basis. So where there's a gift, that becomes what they call carryover basis. And that was very tough to try to figure out what that carryover basis might have been.
Well, thank you. Thank you for that, John. Yeah, it's one of those tricky things of estate planning law that actually has bearing in disaster law here. And let me see if I can, there we go. Ray had a question. Our accountant wants to know the basis for our lost home. So it was owner built over a 20-year period, 1970 to 90, and they paid cash as they went. So how do they figure out basis in that case? And they're planning to spend 100% of the in settlement monies and more to rebuild the home that's equivalent to what they lost.
So I've had a couple of situations like this, and one, it turned out that the contractor was still around and he had the set of plans for that house. And what the contractor was able to do was to come up with a current cost of replacement and adjusted everything out for what might be code upgrades and things like that. And we took that construction to cost today, and we got information from the US Census Bureau on construction costs in various regions of the country. And we basically scaled it back down to the average of the years that that they were building the house. Is it the right number? Is it the, I can't tell you whether it is or not, but it came out to a reasonable number, and we went with it. Now, if you don't have those plans, well, maybe you can find information in a local area, maybe from I don't know, maybe the Chamber of Commerce might even, as to what construction costs were at a certain time. So you look back and say, oh, geez, in this time period, 79 to 90, whatever, average construction costs were maybe just the actual construction costs maybe were $75 a foot. And you have an estimate of the cost of the size of the house, and that might be the best you can do. And you just hope that you're coming up with a reasonable number.
Yeah, the biggest thing I think from what you both have said earlier is you just have to be able to defend those numbers as best you can with the documentation.
Yeah.
Okay, so this is I think a quarter of the questions we've received for today's webinar were on this topic. How, if I'm underinsured, or the question is, if I'm underinsured, do I automatically have a loss for tax purposes? And conversely, if I'm underinsured, why don't I have a loss? And so the answers, the notes we've got here, I'll read through them, and then if you two can just add to these points. No, you don't automatically have a loss. You might actually have a gain in the IRS's view if you paid less for your home than the amount of your dwelling claim, the aggregate payments for your insurance. Your disaster needs a federal disaster declaration for you to be able to claim a casualty loss on your tax return. Your insurance loss is calculated differently than your dwelling's cost basis to determine a casualty loss. You might be subject to a gain if your insurance proceeds are greater than the cost basis of your property. And just to note, there are ways to offset or convert these gains. So anything either of you would like to add to this topic?
Not at this point, other than the fact that we have a slide coming up later with a table on it that I think might be helpful.
All right, well, go ahead, Jared.
No, it's just that they have to go through the calculation process and it's not just as simple as maybe this and maybe that. It has to go through all the dollars and cents and make the calculation to see what happens, and then where you go from there.
Thank you. And there's nothing automatic to it. I know it feels like if you're underinsured, you have a loss, but as Jerry said, you're going to have to do these calculations. So our next section is, do you have an involuntary conversion gain or a casualty loss? And this is just a very simplistic slide to show you what the path is. And this is for a primary residence. The disaster happens if it's a federally qualified disaster. A qualified federally declared disaster. Two options. You're either it's going to be a casualty loss or an involuntary conversion gain. And then we've got parentheses less the primary resident exclusion. If it's not federally declared disaster, you're going straight to the involuntary conversion gain. And then, John, I believe this is the table you were talking about with the form 4684 scenarios. So I'm gonna read A1.
Well, let me just make a comment first. So this table mimics or is based upon the form in the casualty loss form 4684. It follows that pattern. So that's why it's lines 2 to 9, not line 1 to 8, because in that form it's lines 2 to 9 on personal losses. I just want to emphasize that the individual columns here are not cumulative to each other. Each one is an independent calculation, but there's just four different examples that we're giving here.
Right, so we're gonna start with example 1. The cost basis is 176,000, I'm assuming is what we're going with. The insurance they received was 30,000. Gain is 0. Value before the loss, 130,000. Value after loss, 0. Loss, economic loss, line 5 less line 6, 130,000. Line 8 says loss smaller of line 2 or 7, so it's 130,000. And then line 9 says subtract line 3 from line 8. If 0 or less, enter 0, and that's your loss. And so it says for line 9 for this first example, 100,000.
So the general calculation here, which we just went through, but what happens is we have cost basis 176, and we have a decrease in fair market value. The code says you calculate both of those numbers, and then your loss is limited to the lesser of those two. So that's how we came up with the 130, and the 176 became irrelevant. And then the 130 then got reduced by the insurance proceeds to come down to the 100.
Got it. And so, John, I'm going to go ahead and give you example 2.
Okay.
Same cost basis, $176,000. Insurance proceeds of $150,000. The value before loss, $130,000. Value after loss, 0. Line 7, the loss, the economic loss is $130,000 again. Loss, line 8, the loss is the smaller of line 2 or 7. It's again, it says 130,000. But when we're looking at the loss on line 9, where we subtract 3 from 8, it's 0.
Because the $150,000 of insurance proceeds is greater than that economic loss of 130. So we don't have a gain, but we don't have a loss.
Got it.
We don't
And
have a
then-
gain because the 150 is less than our 176.
All right, then let me run through example 3. Cost basis again, 176,000, insurance 150,000, value before the loss of 300,000. So the property appreciated. Value after loss 120,000. I'm assuming that's a land value if it's a total loss.
Might be something else, but it's just generic.
Right, and then line 7 is the economic loss, 180,000, which is the difference between the loss before the gain and the loss at the value after the loss, before the loss and after the loss. Line 8 is the smaller of line 2 or 7, $176,000. And then to calculate the loss on line 9, it says subtract 3 from 8, gives us $26,000. So that person actually has a gain, correct?
Sorry, say that.
Do they have a gain or a loss?
No, okay. No, they have, wait a minute, I'm sorry. We had 176,000. Our proceeds, excuse me, yes, our proceeds were 180,000.
Yes.
Okay, so our proceeds are, they have a slight gain.
Okay, so it's 26,000, so slight gain.
Right.
All right, and then example 4 is really simple. Cost base is 126,000. Insurance 150,000, and then it just goes to line 4. They have a gain of 24,000.
Right, so this was a lower cost. Now, you can put that gain and report it on the 4684 and pay the tax, But if you're in that situation where you've got that gain, then you're not going to use the Form 4684. You're now in an involuntary conversion situation, and you have the opportunity to defer that gain by reinvesting those proceeds that were received.
All right, so next slide is talking about, do you have a casualty loss? So the guidance is probably not. It's rare that this is established and documented. This is for people with insurance, correct? I know Jerry, and the hurricanes, it might be different because of the flood insurance and lack thereof. But for note, if you don't have a casualty loss, other provisions of the disaster tax code can be of assistance in reducing any potential tax burden. So it's good news, not bad, not having the loss. Because that loss means you really do have no resources, correct, Jerry?
There's something to think about is that your December storms, the way that those work out with insurance and with rebuilding may be a little different than what people are accustomed to with the fires. So that's something that we'll just have to see how that sorts out. A fire, I think the insurance companies might be a little bit more willing to pay off with a fire claim than with some of these windstorm claims. So
Right.
I don't know what's going to happen with the landscape's going to be going forward for that particular set of circumstances.
Well, that feeds into this, the personal casualty loss is the lesser of the cost basis of the damaged or destroyed property or the decline in fair market value before and after the casualty, reduced by all insurance reimbursements and payments and proceeds. If you were impacted by flood and wind, had no flood insurance, and your wind damage is minimal, you're going to have very minimal insurance payments, as Jerry said, which is, it might put you into a casualty loss game. All right, what about Form 4684? So if you don't have a casualty loss, then you don't fill out this form. And this is one of the mistakes I hear from people repeatedly, is that that's the form they think they have to fill out because it's the only form the IRS provides for disaster taxes. Now, publication 547 explains if you have a gain, you must provide that statement attached to the return with all the circumstances reported. There's 15 items to be addressed. It's a little bit complicated. So in other words, this area is so complex that the IRS doesn't even provide a form for reporting. Is that a fair statement, gentlemen?
Yeah, definitely. I would add also that when you are in a situation where it's a casualty loss, then it's a pinpoint identification. What is the date that we have for the loss based upon not only it occurred, but it was settled. So we have the date that's sustained. But where we've got an involuntary conversion, the loss occurred in 1 year, the insurance proceeds are collected in another year, and then the construction or the replacement happens in another year or subsequent years. These things happen over, I've got some going back to 2017 that will extend into 2023 and 24. These are what I call episodic transactions. And each year there is reporting that basically tells the IRS, this is what we've done cumulatively, and this is what we've accomplished this year. And we'll get back to you next year with the next chapter. So each one of those reports is kind of a chapter in a book that you're writing about your disaster from a tax point of view, that all of those put together will tell the complete story from an income tax point of view.
Well, so gentlemen, with this form, going back to determining your cost basis and waiting, if you've got insurance proceeds, figuring this out. So if you're maneuvering in a total loss insurance case, a wildfire case, you might need to file your return with the information you know, but you might end up going back and filing an amendment, correct? Because
No.
what would you do? That's why I want to,
If your insurance claim is still active and you expect to get additional money, then the claim has not been settled, and therefore you cannot compute a casualty loss because you don't know what your proceeds are. If you're involved in a lawsuit against a public utility, you don't know what the outcome of that is going to be, and until that lawsuit is settled, you don't know if you have a loss. So once all of those claims are settled, and then you add up all the numbers, and then if it comes out to a loss, well, that's the loss that you take on that return. So let's say that, forget the lawsuit, but just say that you've got a 2020, you lost your house, but then in 2023, you finally settle all of your claims with the insurance company and you're done. And now you compute, oh, I have a loss. Well, that is a loss that you claim on your 2023 return. But because it's a federally declared disaster, then you have the opportunity that you can claim that on the 2023 return, or you can also claim it on the 2022 return. But it's still the 2023 loss that you're claiming on the year previous.
got it, thank you. And then this is the form we were just talking about. And as you can see, what John was talking about, the lines in his example, it starts with line 2. This all matches up here. And John, it's just doing the
Yeah, it's just pointing out. It's okay.
and so for both of you, how to substantiate a casualty loss. So our notes here say it's similar to what's required for insurance companies. You've got to be able to show the type of loss, the date it occurred. The loss was a direct result of the casualty. You have to have proof you own the property, for lease and damage property, that you were contractually liable. Whether a claim for reimbursement exists, is there a reasonable expectation for recovery? And then, documented evidence to support the claim loss.
That's kind of a recap of everything that we've been talking about, starting with the immediately after the disaster, and accumulating all the information and keeping it in some kind of good orderly fashion.
I guess one of the things we really haven't talked about, and I can't remember if we're going to talk about it later, Val, and that's we didn't really get into this fair market value before and after the event. And that's sort of an interesting concept there, because technically it is literally those two evaluations. I tell people they are literally a nanosecond apart. 1 second, you've got a home in perfect condition. A second later, it's a pile of ash, or it's washed down the river. And so what is the value of that property before? That's a fairly simple one, but in either case, these require reports by a qualified appraiser, not a real estate agent, but a qualified licensed, if the state requires licenses, licensed appraiser. And the one ahead, the first one, is basically, well, what would the property sell for? That's generally an easy one to do. The one after is more complex, and there are certain adjustments that the IRS requires, and there's certain other adjustments that you can include that are beneficial in terms of raising the loss. But those all have to be incorporated into that appraisal done by the qualified appraiser. So it takes some education sometimes of the appraiser himself. And in fact, I've got a booklet that I wrote as a result of that 2013 flood that I actually provide to any appraiser who wants it, that goes through and gives them information on how to go about and make the special adjustments.
Thank you for that. Jerry, I actually have a question about home was not damaged, destroyed by the hurricane, but it's in an area that's been devastated. And so the question is, my realtor thinks the value of my home decreased $100,000 as a result of the destruction. Do I have a casualty loss?
No, the temporary decline in fair market value does not result in a casualty loss. There's a case that litigated that, and that was the court decision. So that sticks. That's the law now.
Yeah, there has to be actual physical damage.
Okay, all right, thank you.
Yeah, the case is called Finkboner, Finkbohner. If anybody wants to Google that term.
Yeah, it's a great case.
All right, and then following up on what you said, John. So when we're talking about determining the amount of the loss, you mentioned appraisal method, cost of repairs, which is subsequent receipts, safe harbor computations, year to deduct, loss sustained or prior year, loss cannot exceed cost basis. Going back to Karen's question, where do you find those qualified appraisers?
My suggestion always is to start with a local realtor or a banker, or Google.
Yeah, the term in the regulations is competent appraisal. Qualified appraisal is used in code section 170 for charitable contributions. But as far as competent appraisals, this is something that I never got a handle on until 2016. Going back to 2005, we knew that term was there after Katrina, and IRS never really elaborated on it. In 2016, I did some research and I found 4 cases on the subject of what was considered a qualified appraisal. And so there are cases on that subject as to, and in maybe 1 or 2 of those cases, the court accepted the taxpayer's appraisal as being the measurement of the decline in fair market value. Now, to do away with that problem, they put something in code section 165, which deals with losses, to where an SBA or a FEMA appraisal can be used. So if you don't have insurance and you don't have an adjuster's report, then the taxpayer may apply to SBA or to FEMA for a grant or a loan. And in that instance, it appears that what they're doing is they're going in with their own adjusters and they're doing their own adjusters reports. And so that may be a measurement of the decline in fair market value for purposes of a casualty loss.
I totally agree with you on that, Jerry. The only thing I would add to that is that those agencies may not have their interest is how much of a loan can they give, and they may have a maximum loan that they're willing to give. And so if they reach that amount, that might be the way that they appraise it. But in fact, the appraisal of the actual loss might be in excess of that.
Yes, I haven't seen any. I know I think the FEMA grant is limited to maybe 30,000, but SBA can go much higher. SBA, I mean, the caveat with SBA is that they're going to cross collateralize everything that you own. So that's something that the victim has to take into consideration. Now, the safe harbor computations is way more than we could talk about today, but that's a revenue procedure. So again, you'd have to Google revenue procedure 2018-08, I think. It's
08 and 09.
What is that?
08 and 09.
Yeah, 08. Well, one of them deals with safe harbor tables, and it was only applicable for Irma, for Harvey, Irma, and Maria.
Right.
So one of them deals with, I think, 5 methods of computing a casualty loss, and so that's what we're talking about with safe harbor. So that's available. You can Google that on, and it'll take you to the document, and you can read the document and see what it is. I mean, the safe harbor methods. The one of them is a completed contract. The contractor, meaning that you have a signed contract with a licensed contractor. Another one is the insurance adjuster's report, meaning that you use the adjuster's report as a measurement of decline in value. And also there's a section on that on personal belongings, and you just have to follow the examples in the revenue procedure. So those are available, but they way beyond what we can cover here in this short period of time.
Thank you for that. Going back, information needed to report a casualty loss. So we've got cost basis or other basis of each property, insurance or other reimbursement, fair market value of property before the casualty, fair market value after, not necessarily zero, even if completely destroyed because the land remains. We've touched on this. This is just to recap that. What to know about reporting. Gain on unscheduled property. Gain is not taxable. And no tax reporting disclosure necessary for primary personal residence in a federally declared disaster. Proceeds on scheduled property is separate from unscheduled property and treated as if it were real property, in parentheses, added to cost basis of real property. And the insurance proceeds get added to the real property proceeds. So they're treated as a single item of property. If reimbursements for business property or personal residence are not received until the year following the disaster in a gain situation, and there is no intention to reinvest, you report in the year the reimbursement is received. Anything to add to that, gentlemen?
No.
No, that's pretty straightforward.
All right, and then we got here, we've got our federally qualified declared disaster, casualty loss. So if you have the federally declared disaster and a casualty loss, you're filing form 4864. Really simple. Simple as we can make it. So now involuntary conversion gain. So do you have one? It's very possible, especially if your home was purchased many years ago and values have risen. You can have a gain even if you're underinsured. Again, those IRS regulations provide help to offset or defer the gains from involuntary conversions, and there are ways to reduce that gain while following the regulations. And this is our little very simplistic chart. So again, federally declared disaster. If you have an involuntary conversion gain, this is less the primary residence exclusion, the 250 or 500,000. If you've been in the home, what, 5 years, gentlemen? 2 of 5 years, 3 of 5?
Correct.
So if you anticipate rebuilding or replacing the home, you're looking at deferring the gain. If you're not rebuilding, replacing the home, balance taxable is on Schedule D. If it is not a federally declared disaster and you have involuntary conversion gain, and again, the very simplistic chart. So it's not a federally declared disaster. You have the involuntary conversion gain less your property residence exclusion. You anticipate rebuilding, you're going to defer the remaining gain. If you're not rebuilding, replacing, repairing the home, the balance is taxable again on Schedule D. So if you have a gain, because we keep talking about deferring it now. So can you defer it? So an involuntary conversion gain may occur if payments exceed the cost basis of the property. For personal primary residences, it may be possible to utilize an exclusion to offset the gain under sale of personal residence rules. This is IRC section 121. I know you gentlemen have already talked about that briefly. It is possible to defer the gain if the reimbursements are reinvested in rebuilding the home or acquiring a replacement home or homes within 4 years. If it's a federally declared disaster, and this is 4 years, not from the event, but from the end of the first year that you realized a gain. Or 2 years if it's not a primary resident. And again, this runs from the end of the first year you have a gain, not from the date of the disaster. And I know you both talked about that earlier. it just makes this timekeeping really complicated to have to keep this in mind.
That's true. And it's something that also, let's say again that the loss was, the event was in 2020 and you received some proceeds in 20 and you received some proceeds in 21, but you haven't hit that, you haven't hit the threshold of being a gain. One thing you don't want to do is you don't want to make an election to defer the gain under 1033 on those years. There's no need to make that election. You're just reporting facts and telling them we'll get back to you when we know more. And then so that's 2021 and then 2022. Now you have, all of a sudden you flipped over and you've got a gain. Well, sometimes clients look at that and say, you know what? I'm not going to rebuild. I'm just going to move into an apartment. I'm just going to pay the tax. As long as they haven't made the election to replace, they can do that. But if on one of those prior returns, they made the election to replace, then they're locked into that election. You cannot revoke an election once it's made. The only thing you can do is run the clock on that 4-year period. And then you've got a problem because now you've got the gain in 2022, but you have to wait until January 1st of 2025, excuse me, 2027, and then go back and file an amended return for 2022 and pay the tax. And now you've got 4 years worth of interest to pay, possibly penalties. So you want to be careful. Don't make that election too prematurely.
All right. We've got a question from Lynn in Colorado. So she plans to settle with her insurance company in 2023 with a replacement property, and she's going to sell her lot. As it relates to the tax exclusion, she's filing jointly, so the $500,000. What should she do to maximize this tax benefit for the dwelling and the lot?
Well, first of all, the sale of the lot, let's say that, let's put the lot sale aside for a second, and let's say that there's a gain from the insurance proceeds, but it does not eat up all of that $500,000 exclusion. Let's say there's $150,000 that has not been applied. Only $350,000 was used on the insurance proceeds, and now you sell the lot. Well, if the lot is sold within 2 years on the calendar, not so date the same date as the event 2 years later, if it's sold within that 2-year period, and then you most likely will have a gain because your cost basis at that point is most likely is zero. That gain, you can apply the rest of that $150,000. But if the sale takes place more than 2 years after the date of the event, then you cannot use the 121 exclusion against the lot sale. However, if you receive more insurance proceeds more than 2 years after the event, yes, you can still use the 121 exclusion against those proceeds, because you're basically collecting on a claim that existed as of the date of the event.
On the screen, we've got the rules for using that primary residence exclusion, the IRC 121. So it's you may exclude up to 250 per individual or 500 per married couple. You have to have complete destruction of a personal use primary residence, unforeseen circumstances, modified general rules. And as Jerry mentioned earlier, it must have been your personal residence 2 out of the last 5 years. If it was less than 2 years, you get it's prorated, that exclusion. And then I'm going to bump us directly to Barbara from Colorado's question. So she's lost the home of 23 years, decided to rebuild elsewhere. They are in a federally declared disaster. She said we can postpone paying taxes on the gain if we build a home that is greater in value than our burned home's cost basis. Insurance, in parentheses, insurance proceeds plus what we sell the land for. Once we declare a replacement home, we cannot substitute a later home to again postpone gain. Is that correct?
Technically, that is correct. However, if you never moved into, if upon completing the construction of that property, you don't move into it and you turn it into rental property, then it was not qualified replacement property and it fails on that basis. And then you could start all over. I don't recommend that as a planning device, but that is a matter of fact, because I've seen people who, well, they rebuilt and then they immediately turned it into rental property thinking that they had replaced the property. And I said, no, you haven't replaced the property. You've bought it. You've built rental property. But there's also the possibility, again, of acquiring more than one replacement property. And so then the gain gets spread out over several properties, and maybe what you're doing is one property, you live in that for 2 years and you get to use your $500,000 exclusion all over again.
Thank you. And I know, Jerry, and with some of the more recent Florida hurricanes that where people did have insurance proceeds, I know some of them ended up with replacing with multiple homes. And so I know that would get, obviously flood insurance wouldn't be related. It would have to be wind damage or whatever else to be able to follow that with a traditional homeowner's insurance policy, correct?
I think so. We're kind of sorting out the Ian and Nicole damage now and where it's going with the insurance. I don't have a feel for it yet. Probably after next week, we'll hear more about it.
Okay. All right. And then up on the screen now, we've just got basically a table showing that involuntary conversion, that IRC 121. This is that example. Primary residence purchased for $150,000, $25,000 in improvements. Home was destroyed. Instead of rebuilding, they purchased a $275,000 home and retained the lot. And so all of these calculations basically lead to, they have a gain of $25,000 taxable in the year the last $25,000 of the insurance proceeds are received. And let me go ahead and bump this to our next slide. And we've talked about this several times, but how long do you have to replace the property using the tax exclusions on involuntary conversion gain? Deadline of 4 years for primary personal residence with that federally declared disaster. Deadline of 2 years for all others. And I believe you both have mentioned that extensions may be available, must be filed, and they should be filed basically the year that you need it, right?
Yeah, at the end of the year that your replacement period would be expiring, that's when you file the extension request.
Got it. And then just again to note here, when we're talking 4 years, 2 years, it's not from the event, but the end of the first year, you first realize a gain.
Absolutely.
All right, next one. Can you buy multiple properties to offset an involuntary conversion gain? We've talked about this before, that you can buy multiple smaller properties, no limit on the number of replacement properties, to avoid an involuntary conversion gain. Must be similar or related. Acquisition of replacement contents also counts. Replacement period time limits must be followed or again, formally extended. And we
just back.
go back. Yes.
Yeah. So I just want to emphasize what's similar related. What you lost was your primary personal residence, but in terms of similar or related, what you lost was a personal use residence. So in terms of replacing it or buying multiple properties, as long as those multiple properties are personal use, none of them even have to be a primary residence. They just have to be personal use real estate, not rental, not commercial.
Got it. No taco trucks. Yes.
No taco trucks.
All right. So, and I know this is a question a lot of people have about selling the lot. So if I sell my lot, will the proceeds be taxable? The sale of the residual land can, in most cases, be treated the same as if it is proceeds received from insurance. It will likely be substantially all gain. But as I believe both of you mentioned earlier, if your exclusion, the 250 or 500,000 has not been fully used prior to the sale of the land, it can be applied to the land sale. But that's only if the sale closed within 2 years of the date of the loss. That's the complication there.
Right. And why is it all gain? Because remember, we started out with the integral nature of the real property. So we're looking at the total cost basis. So the reason we have a gain is because the insurance proceeds have exceeded our total cost basis. And so now we're in a gain position, which means we have no cost basis left. So now we sell the lot, it is all gain. Now, what may happen is before you sell the lot, you may have incurred costs for debris removal, or maybe you even started expending some costs to investigate rebuilding, paid some architect's fees. So you've actually spent money on replacement property rebuilding. If you then go to sell that property, those costs are included as part of your cost of sales, so to speak, reducing the amount of your net proceeds from the sale of the lot, which are also reduced by sales commissions and closing costs.
All right, thank you. Next slide, reporting an involuntary conversion gain. I know you both have mentioned this earlier. It's required annually, reporting detailing the overall and current status of the process, as well as other data and information. Accuracy and completeness of this reporting is the key to communicating with the IRS and state tax offices in order to meet all requirements. And as we mentioned earlier, there is no pre-printed form provided by the IRS. And these reports are just part of your regular income tax return. And they're included starting the year of the loss and end upon the completion of the replacement process.
So because these are not part of any tax software program, either you're going to be, if it's in the case of software like TurboTax, they do not allow you to add attachments such as PDFs. So you end up that you're going to have to file by paper. If it's being filed using software, professional software that allows for attachments, then whatever that statement is, that information, it gets converted to a PDF and gets attached by the tax preparer as an additional just as an attachment to the electronically filed return.
We're going to touch on some other considerations here. What are your circumstances? You just want to, think about what happened during this process. Was it a rental property, a second home? Do you have a trust? Is there a lot sale, lawsuit, divorce, death, change of use, business loss, taxes? All of these feed into this, what you're doing here. So which payments may be taxable by the IRS, unemployment compensation, reimbursement for items already reimbursed, payments in excess of basis and personal residence, some ALE proceeds if they are used to purchase an asset rather than pay for temporary living expenses. Sometimes insurance proceeds related to contents, also contents in a second home, even if it's a federally declared disaster, and then lawsuit proceeds, depending on what they're for. And just to be really frank, lawsuit proceeds it's a complex issue and it's beyond the basics of this webinar. We will not be touching on that in any detail. Go to the next slide. Which payments are not considered taxable by the IRS? So payments for ALE, as long as they're being used to pay for temporary living expenses. This can include insurance proceeds and FEMA payments. And again, payments from social welfare agencies, and then other payments from FEMA. And then tax treatments of ALE. Sorry, I'm having fun with the dog here. So insurance proceeds for ALE are not taxable as long as they're used for actual living expenses. That's expenses incurred after the event, not part of the disaster itself. They're not part of the casualty loss calculations. Excess insurance proceeds for ALE are taxable in the year you're no longer incurring those additional living expenses. However, if you're purchasing temporary home and RV with your ALE proceeds, that's not considered an ALE expense, and the acquisition of a capital asset results in those remaining unspent ALE proceeds becoming taxable. You can treat it as part of a replacement property. You could spread that deferred gain over more properties. And if you live in it for at least 2 years and sell it to move into a permanent home, you can apply that gain on that property up to your $250,000 or $500,000 exclusion. Be aware, once you move into that capital asset you purchase as a temporary resident, obviously you're no longer incurring additional living expenses. And again, whatever's left over becomes taxable. One of the questions we hear a lot is, what do I do if I make a lease purchase agreement, buy a temporary home through my business and lease it to myself? That's a trick a lot of people like to do. And would you gentlemen like to address that?
Ignore the transaction. You can't lease to yourself.
With hurricanes, the insurance doesn't pay off, very rarely pays off the additional living expenses. Basically, you're on your own, and I very rarely run across it.
All right. Yeah, thank you. And for anyone with flooding or the wind damage, being aware that flood insurance generally does not provide ALE, and unless the wind damage impacted the envelope of the home, your ALE is not going to be triggered. So you would not be getting funds for that.
I've been told that is regulated and mandated maybe by either your insurance department or the legislature, that it has to be included in policies. But again, I have no knowledge of what the situation is in California. I know you get that. I know that I don't see it here. I've only seen it once, and I don't really know what kind of policy the people had. What happened was it was a tree fell on the house and destroyed a big oak tree and destroyed the whole house. And so there was living expenses that were in the policy, but I don't see living expenses with any other with windstorm or flood. So that's something that's unique to you guys out in California. I don't expect to see it in Florida either.
Yeah, the basic homeowner policies in California, at least, and I think also in Colorado, basically most of them have four categories: structure, other structures, contents, and additional living expense. And other structures is basically thought of as anything of improvements, any kind of land improvements that are not physically attached to the house. So it might be a fence, it might be a detached garage. I tell people that, in the 1800s, that was the barn. On the other hand, there's one insurance company that combines A and B, so they only have A, B, and C.
All right. And this is the extent of what we're going to talk about with legal litigation proceeds. Most litigation is providing a net number. They're not providing documentation that's going to break out what your proceeds are for. And so this is something that's going to require a complex analysis. It depends on what type of litigation you've got. These call outs below, those 4 bullets, are just information to be aware, like compensation for medical care, bodily injury is generally not taxable, but you're going to treat this in the same manner as insurance proceeds. Okay. And again, this is something that if you're in this situation, you need to be talking to a professional about this.
This is what they're going through right now with the train derailment, trying to figure out the payments that they're making, the insurance companies are making, the railroad is making, as to what the tax consequences are going to be, what they exactly relate to. And so it's gonna also depend upon the legal documents. And remember that a tort lawyer is not necessarily knowledgeable in tax law, so that the settlement document may not be favorable for your tax situation. So that's something that you have to think about when you're going through the legal process.
Yeah. Now, if you were impacted by the Fire Victims Trust Fund, they are a third party. They're making determinations on your claim. And so if they're providing you tax documentation, that will tell you exactly what aligns with your real property contents, ALE, and all of that stuff. Okay, and this section is reporting business-related losses different than personal losses. In a nutshell, there's a different standard for qualified replacement property for business losses. That gain on involuntary conversion calculation is similar to personal property with the following differences. The land is not included unless it's sold due to no longer being economically viable to the owner. No exclusion on the gain available. Deduction is not limited by 10% of AGI and $100. And Jerry, I'll let you talk about that in a minute. And loss must be substantiated similar to the individual losses, either providing that inventory and having that cost basis based on your depreciation schedule computed up through the date of your event. You can't have had it 20 years ago and it's still on the books, but you've already depreciated it over the last several years of tax returns. So Jerry, can you talk about that 10% of AGI?
The 10% of AGI was put in the budget bill. Well, I mean, I'm sorry, this is business property. Okay, all business property is you don't have the problem that you do with the personal residence of having to compute basis. In most instances, the business property is going to be on a schedule C, E, F, a business return at 1065 and 1120 and 1120S. And there's going to be a depreciation schedule. And so you're going to have the basis. And so that exercise is not going to enter into it. And with the business property, if there is insurance received, it's going to qualify for an involuntary conversion, and you're going to have a 2-year replacement property. So the calculation is on page 2 of Form 4684, and it's less, let's say, complicated than maybe trying to compute basis on individual property.
All right, thank you. And you led right into the next slide. Appreciate that. And so let me go to the next slide. So tax implications from losing a second home. So I know a lot of the folks that were impacted by Hurricane Ian, the 2020 Colorado fires, several of the 2020, 2021, and 2022 California fires up in the mountain areas. These were vacation and second homes. And so big thing is there's no exclusion available, right? So you have 2 years to replace, beginning calendar year, again, when the total proceeds exceed that cost basis. You can ask for extensions 1 year at a time. Note, combine the landscaping, the land, the building improvements, the building itself into one unit, one number. And then these, unlike your primary residence, contents proceeds are subject to regular recovery rules. Have to determine cost basis and document insurance proceeds. Anything either of you would like to add on that?
I don't think so.
Just one thing about those what they call the extensions on the 1033 period. I'm hearing from some of John's colleagues in California that they have a difficult time getting the extensions through IRS. And I think the people in Florida after Hurricane Michael are having a tough time getting the extensions through IRS. So that's not an automatic extension. It has to be in writing to the address where the return is filed. So whoever is thinking about that, just be forewarned that this is not automatic and it may not be simple. It's very time consuming.
Yeah, and all these extensions, they all end up on the desk of a poor lady down in Houston, Texas, who's the involuntary conversion coordinator. going back several years of the California fires from 2017. The first year I had to ask for an extension, I filed 6. The second year was 11. The third year was 16, and this past year was 30. So she's getting a lot more of these. And last year, the ones that I filed by December 31st of 21, I did not get the approvals until after the April 15th filing date. I think they came in around April 30th. This year, I think it's gonna, I've talked to them down there in Houston. I put them on notice that, you know, that they're gonna get inundated. It's only gonna get worse. So I don't know if they're adding any additional people looking at these things, but I have not had trouble getting the extension. It's just when I get the extension. So they've, all of my extensions that I've put in, I've never had one denied. So I don't know if Jerry, you're talking to people that are having them denied, or they're just not getting them, getting the information back.
Both, but
Okay.
the people here, they tell me that they have, that their answers come from somebody in California. Whereas I guess what you say, the people in California get an answer from someone in Texas, so.
Well, I think they all end up, because the first year I did what you said, and I filed some in Fresno and some in Ogden based upon where the tax returns were filed. And then I actually got the approvals from an office in Louisiana. And the second year, and that office included a fax number. And so the second year I just faxed them, and I got a call from the group manager saying, oh, she's retiring. Because I filed them like around the 25th or something of December. And I got a call from the group manager saying, that, oh, she's retiring at the end of the year. So somebody else is doing that, but it's all coming through this office now. And so as far as I know, they all end up in, they should all be ending up in Houston.
Okay, well, that gets into the question Paul has. So the Caldor fire, and so here we've got 177 cabins that are probably going to be filing extensions. They're waiting on the Forest Service to decide whether they can rebuild the cabins that were, you know, where they had the leases. So these are not primary homes. So they're looking at that, you know, 2-year window here. They've also got a short building season. So his question is, how do you go about getting the extension? Obviously, John, you said once you found a fax number, you use that.
Right.
Versus mailing it in. From a documentation, you know, what do you suggest people provide? Because this situation is pretty clear. The federal government, the Forest Service, is the reason for the delay.
Well, first of all, again, the IRS does not have a form for this, but they have a lot of things that they want to know. So basically, you're needing to tell them all of the basic facts of the date of the fire, the date that you first realized a gain, what your expiration date is, and a couple of other details like that. And then you're basically telling them a story. You're telling them, well, why do you need the extension? I've had some of those that are, you know, maybe a couple of, maybe about 10, 15 sentences. I had one that went on for two pages. And then in addition, if there's any report that have been filed for years, which there should have been, then copies of the most current report and the year prior. And then, of course, if you're doing this through an accountant, then you're going to end up, the accountants are going to be filing this, and they're going to need a power of attorney. So sometimes these things can be, with a cover letter and everything, they can be 10, 11 pages.
Thank you for clarifying that. All right, so tax implications from losing a rental property, and this is in every state that we've been operating the last couple of years. This has been a big issue. So rentals being considered investment property. You know, there's no loss of rental income because they didn't pay taxes on the rental income they didn't receive. If they weren't insured, like Jerry said earlier, most likely you have a casualty loss. If you were insured, these calculations are all going to matter. You should have on your tax returns the depreciation schedule from previous tax returns to use in your calculations. You're going to identify the items lost. The land is not lost. It's not part of the casualty loss. You're landscaping the building. That's becoming the basis for determining the loss. And the loss is simply the adjusted basis of property at the time of the disaster. And there was a comment here that you potentially skip the before after appraisals.
Yeah,
Anything to add there?
no. I think that covers it.
All right, when we go to timber lumber sales, this is more for Oregon, Washington, Colorado, California with the wildfires here. So if you had land zone for timber production, the value of that land had most likely, for the trees had most likely increased. But your homeowner's insurance is not going to cover your timber loss. It's just not an insured part of your policy. And so the guidance is determine the appraised value of property overall, which includes the trees before and after the disaster. And the thing to note is you cannot add the cost to remove the trees post-fire because it can't be calculated into the cost basis.
Your state forestry service may have some resources on the subject of how to handle the trees. And something tells me the Department of Agriculture on the federal level that there's a lady there who's a PhD who has published a lot of material on this topic.
Excellent. All right,
Also, there may be situations where the trees are essentially dead, but they're still you can still harvest some of that wood,
right.
and it's possible to treat that wood. That wood harvesting proceeds is basically the same as you would treat insurance proceeds. So either reducing your loss or maybe you might have had a gain, and therefore you can end up deferring the gain.
Got it. Thank you.
I would think because this last weather you had in December that you might have some crop damage, but again,
Yes.
I don't know what the particulars are, but again,
So
the crop
definitely.
damage in Georgia after Hurricane Michael, there was pecan trees destroyed. And so the pecan trees evidently take like 10 years to come to full size. And the subject, because there was no basis, they didn't have a loss, but the state had come up with something to compensate the pecan farmers. So maybe the state or the feds come up with something to compensate on your crop losses. And again, I don't know. So
Well,
whether
Watsonville had that, yeah. So Santa Cruz County definitely had crop losses, and some of the interior counties, yeah.
I mean, I don't know. Like, if you had it in the Monterey Peninsula, I thought you had a lot of farming there, but
Yes,
it's
yeah.
been years since I've been there. So they may get compensated either by the feds or by the state. So that's something that's just we'll have to work that out as it goes along.
Got it. Thank you. Taxes and a partial loss. So we have a lot of smoke damage, thermal damage from fires, for the flooding, a lot of partial losses here. Wind damage, roof and windows and doors, things like that impacted. So since the primary residence itself is not destroyed, that exclusion of the 250,000 or 500,000 is not available. If your insurance proceeds were reasonable, it may still be less than the cost basis. So you probably don't have an involuntary conversion gain. We talked about this earlier. Do you have a casualty loss? So it's going to depend. You start with your cost basis and your insurance proceeds. Here's an example that walks through that. Jerry, anything to add to that?
No, I mean, all of these are mechanical calculations is what I would say. You just have to get all the facts in order, put them on a piece of paper and go through the calculations the way the form computes it, or the examples in the regs and in the material. And it's a tedious process. Again, we get back to having good records and a good handle on the figures that you're going to use for these calculations.
And so basically, no matter how you slice it, you still have to do these calculations, correct?
Yeah. Mhm.
All right, debris removal. While insurance proceeds may be paid directly to FEMA, if it's part of the government coordinated plan, that debris removal payments are still going to be reported as your claim proceeds. And it's also going to become money you spent as part of your replacement costs. And so if you sell the lot, the net proceeds after the commission will be taxable, and you can subtract those expenses you incurred off the net sale of the land. As John mentioned earlier, it's like treated as an investment in the lot. And the sale of the lot may or may not be covered under 121. And this is our last slide of substance, and then we have 2 questions to answer. So do you want or need professional help? Adhering to time limits, these allowances established by the tax code reporting, they're extremely important to protect your resources. Failing to report a disaster event on a tax return can result in totally avoidable penalties, loss of valuable tax opportunities. It is very difficult to correctly calculate and successfully claim a casualty loss. Reporting an involuntary conversion is more difficult. So we highly recommend that you consult a qualified vetted expert. TurboTax, Tax Act do not deal with the complexities. You wouldn't ask a pediatrician to perform a root canal. You don't want to ask someone who has no experience in this to do this. And if your CPA does not know how to do this piece, Jerry is actually doing a training next week for the Florida Society of CPAs on casualty loss taxes. John had offered to do one in Colorado the month before the Marshall fire. There are ways for your CPA to get the information to know how to do this. I'm going to get our last 2 questions. So Tanya in Colorado, she has a casualty gain to defer. She's not going to owe money because she's going to spend it all on her new build, and it's less than 500,000. So I can do a 1033 election. What is the worst thing that can happen if I file my own taxes, gentlemen?
Don't want to take a risk of answering that question. Sorry.
What would you caution this individual about?
Well, you gotta make sure that you've crossed your T's and dotted your I's, like we've been, talking for the last hour or so. So there's just a lot of details, and it's most CPA, even at the CPA level, it's possible to get through a whole career without having to deal with one of these things. And often when it does occur, the CPA only has one client that is affected, and they're very, they don't have the time to do the hours of research to understand what's going on. So it becomes a real problem that they don't have the experience, they don't have the expertise, but yet they've got the license, and it can be a real problem. And if the CPAs are having trouble doing it, well, individual taxpayers have even less information about the tax laws to be able to do it correctly.
Well, and that feeds directly into Barbara's question. She's not able to find a good CPA versed in this area, so her plans to file for an extension and then hopefully find the right person. She said they thought they had a good one last year, but then it did not work well. So A, how to find them, and B, what's the best strategy if you cannot get a CPA versed in this area?
Jerry, you have any thoughts?
I hear this all the time. Sometimes maybe try and contact the CPA society in your state to see if they have a referral program, and some states do, some states don't. I just don't know. This is a common problem today because the area is just, this is complicated. Everything else is complicated. And so part of it has to do with Congress keeps changing the laws, but, just see the referrals. I mean, the neighbors or somebody else must have had, who had a similar set of circumstances to see what they did, and maybe that would get you, pointed in the right direction.
But ignore the neighbor who says they're not going to do anything.
It's,
Alright.
this is a problem. I mean, one of the things we never had in Katrina was after Katrina, the only thing we had was talk radio. So when you turn on the radio in the morning at 6 o'clock, when it went on the radio, it would be where you could buy ice, what grocery stores were open, what gas stations were open, and then you had to who had lumber, who had building materials, and then you had to venture out and go figure out, stand in line to see where you could find these things. I mean, the ice sold out in 15 minutes, so 6:15 was gone. I mean, it would be nothing to wait in line an hour to get gas, an hour at the bank, an hour at the grocery store. And so after all of these disasters, that's an issue. Where to find roofing tiles? When are they going to get another shipment in? Well, maybe it's not going to match the color on your roof. Well, if it stops the water from coming in, it really doesn't make any difference. But I mean, this is the trauma that you have to go through after disasters, depending upon what kind of disasters that you have. I mean, the fires, everything burns down to the slab. That's bad, but in one case that's good, because it's not the same as having to come clean up after a flood or a hurricane. So a disaster is a disaster. It's a traumatic event. We're all different and we all react differently. And so that's really, all I can say.
I think that feeds into Barbara's question as well. It's, be aware that when you find a good CPA and you share that information, they can only take so many clients. Be kind when you find people and they say they can't. Ask them if they can recommend somebody who has experience in this, finding a CPA that's willing to educate themselves on this, all of these pieces. All right, let me wrap us up here. To be added to our mailing list, please have people sign up here. These slides deck and the video will be up tomorrow morning. You can also request it by email, but it'll be under events. Our survivor to survivor events are coming up. Please join us. It's a great resource for talking to people who have experienced those same challenges and emotions. Anybody with insurance issues, the Colorado Department of Insurance is here. California Department of Insurance is here. This is our upcoming events. And like I said, you can get those recordings and related resources tomorrow. We have our Ask an Expert forum. So if you have a specific question that didn't get answered today, this is a resource for you to do it. Register, it's free, write in your question, and then we will get you the answers. And we just quickly want to thank our funders. And I'm going to quit sharing my screen. And I would like to thank you, gentlemen, so much for joining us today.
Very welcome.
Giving us your time. It's been greatly appreciated. And I know for a lot of people, you would like more of an answer, but the reality is this is one of those few things that you need professional help on, if at all possible. All right, Carolyn, you can stop recording now. All right, and thank you all.